Hello, everyone. Uh, Welcome to today's first lecture of Unit 1 Corporate Reporting for Strategic Business. So today we will discuss the accounting standards intersect with corporate reporting, exploring the fundamental ethical and professional principles that underpin this important aspect of the business world. So, my name is Yasir Gulfraz. So just raise your hand if you have any issue during my lecture. So before I start, everybody can see my screen and can you hear me?
Yes, I can.
Okay. You just quickly introduce yourself. Matt Anormos.
Yes, hello. Sorry, I had some audio issues, but I can hear you loud and clear.
That's fine, no problem, Matt. You know that you will get a recorded lecture after, finishing. So Aftab, Muhammad Aftabuddin. Hi, Aftab.
I'm hearing also. Yeah, I'm good. Thank you,
Okay,
sir.
you're good. Okay. So, Matt, you are a practicing accountant.
Yes, that is correct.
Okay, Aftab, you are as well.
Yeah, I'm also a finance manager in your company.
Okay, that's good. That's fine. Okay, let's get started now then. Uh, okay. Learning outcome one, understand fundamental ethical and professional principles. Our first object is to grasp the foundational ethical and professional principles that from the fundamentals of accounting standard and corporate reporting. So for integrity and objectivity to confidentiality and professional competence, we will analyze these principles to recognize their significance in the context of strategic business and any comments or any anybody knows about reporting, any comments on this, anyone, any knowledge about 1 to 10 corporate reporting and what is its importance for it? uh Hi Azad, how are you? Are you okay?
Yeah, I'm good over here.
Yeah, I'm fine, thank you very much. I've just started, so
Oh yeah, I'm just trying to open it, but it took a bit time to start it. But anyway, I'm here. Thank you.
okay, no problem, thank you. So, learning outcome one, indicative contents, professional behavior, characteristics, practical examples, compliance with accounting standard, ethical requirements, understanding of the consequences of non-compliance, uh, consequences of unethical behavior, understanding of different accounting bodies in different countries around the world, to include AT, accounting technicians, ACCA, chartered certified accountant, ICAE, chartered accountant of England and Wales. So SEMA, management accountant, SIPFA, chartered accountant of England, basically public finance accounting. So international accounting standard to include AIAS, International Accounting Standard 1, presentation of financial statement, A2, inventories, accounting standard 7, statement of cash flow, 8, uh, accounting policies, changes in accounting estimates and errors, accounting standard 10, event after the reporting period, 16, property, plant and equipment, International Financial Reporting System 15, revenue accounting standard 37, impairment of assets, then provision, contingent liabilities and contingent assets, and then intangible assets. Okay, so all of you from UK?
Yes, I think I don't.
Or who is it outside?
No, I am from UAE. I'm living in UAE. I'm from actually Bangladesh.
No, right now you are in a UAE, I think so. Who's Aftab?
Yes, yes.
Oh, okay. So you are practicing in UAE. So have you done any qualification before UK based like ACCA or ATHE or?
Not in UK base. I am already completing a CA inter in a chartered accountant in Bangladesh.
Oh, okay, okay, that's good, no problem. Okay, so explain the importance of professional behavior and compliance with accounting standard. So, importance of professional behavior and accounting standards. Professional behavior and compliance with accounting standards are paramount in maintaining the integrity and reliability of financial information. These principles serves to uphold transparency, reliability, consistency, and comparability of the financial statements. So professional behavior and in accounting standard ensures transparency in financial reporting by accurately documenting and disclosing financial transactions. Stakeholders gain insights into a company financial health and performance. Uh, yeah. So transparent financial statement build, trust and confidence among investors, creditors, and other stakeholders, facilitating informed decision making. Uh, Reliability of financial information is important for stakeholders to assess a company financial position and performance accurately. Professional behavior entails accurately recording and reporting financial transactions in accordance with established accounting standard. Consistency, comparability of the financial statement. Consistencies accounting practices ensures that similar transactions are treated uniformly across different periods and entities. Compliance with accounting standards promotes consistency in financial sorry. Okay. Consistent application of accounting policies enhance uh, the reliability and relevance of financial statement. Everybody can see my screen and can hear my voice?
Yes, clearly.
Yeah.
Okay. I have to ask because if there is any issue, then I can, try to sort, issue out then. So basically, by understanding to these standards, companies ensures that their financial transactions are recorded and reported in consistent and comparable manner. So this fosters transparency, reliability, and confidence in financial reporting, uh, benefiting both companies and their stakeholders. Okay. Professional versus professionalism. Any comments, Hanesh? Anyone?
Yeah, it's the job or the role that you play and the attitude or the actions that you take within that role. And there are, as we discussed earlier, there are
Yes.
disparities.
Yeah. So basically, professional encompasses a body of theory and knowledge aimed at supporting the public interest. It is characterized by certain essentials and defining characteristics, including, if you can see here, body of the theory and skills, adherence to common code of values and conduct, then accountability, integrity, and trustworthiness in professional practice, acceptance of duty to society. Professions serve a broader, purpose beyond individuals' interests. So professionals recognize their duty to serve the public interest, acting in ways that promote the welfare and well-being of society as a whole. Uh, uh, Professionalism involves taking action to support the public interest through ethical and responsible conduct. Uh, Professionalism, involves taking action to support the public interest through ethical and responsible conduct. Uh, uh, it encompasses behavior and attitudes that reflect a commitment to excellence, integrity, and service. Key aspect of professionalism include, uh, again, I'll go here. If you see that here, taking uh, actions, professionalism, ethical standards. uh, Professionalism require adherence to ethical principles and values. Even in challenging situations, professional prioritize honesty, fairness, and integrity in their interactions and decisions, fostering trusts and confidence among stakeholders. Understanding the this basically understanding the difference between profession and professionalism is essential for professionals to uphold the principle of their respective fields and fulfill their obligations to society. Professionalism and and adhering to ethical standards, professionals contribute to the advancement of their professions and the greater, good of society. So, professionalism is, yeah. So professionalism is fundamental aspect of the accounting professional. Symbolize a set of behavior, attitudes, and ethical standards that contribute to the credibility and integrity of the profession. So let's talk about the key concepts related to professionalism in the accounting professionals. So professional behavior and compliance. Professional behavior imposes a duty on accounting to adhere to relevant laws, regulations, and ethical standards. So this includes avoiding actions that may bring discredit to the profession and ensuring compliance with the ethical guidelines established by professional bodies such as ACCA, Association of Chartered Certified Accountants. So then proactive approach. Over time, the accounting profession has transitioned towards a proactive approach aiming to anticipate and address potential challenges and issues before they arise. So this proactive stance involves taking responsibility for any negative consequences of accounting practices and amending them where appropriate to mitigate adverse impact. Okay, so body of theory and skills, accounting characteristics applicable to the accounting professions. So body of the of theory and skills, adherence to common code of values and conduct, acceptance of a duty of society as a whole. So accounting process, when we talk about body of theory and skills, accounting process technical skills in areas such as auditing and accounting standards. acquired through education, training, examination, CPD, continuing professional developments. So ensures accountants stay, stay uh, 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 abreast of development in their field. So next is adherence to common code of values and conduct is established by administrating body. So the accounting profession upholds a common code of ethics and values established by a governing body to ensure integrity, objectivity, and professionalism in accounting practices, acceptance of duty to society as a whole. Accountants recognize their duty to act in the public interest, maintaining an objective outlook and adhering to ethical standards applicable to all members. So, in return, all their commitment to professionalism, accountants are granted qualification and the right to use professional titles such as ACCA, IFA, AAT accounting technician, or chartered public account. Uh, Professionalism and upholding ethical standards, accountings play a vital role in promoting trust and confidence in financial reporting, thereby contributing to the stability and transparency of the financial market. All good, everyone? Dinesh,
Yeah, all good.
everything is good. Okay. So the regulatory framework, accounting standards. So accounting standards serve as a authoritative guidelines for the preparation and presentation of financial statements, ensuring consistency, comparability, and transparency in financial reporting. So accounting standards are authoritative statements. The dictate how specific types of transactions and events should be reflected in financial statements. They aim to ensure fair presentation and provide a user with a true and fair view of company's financial position and performance. uh, Type of standards, accounting standards, main these two sets of accounting standards: UK accounting standards and international accounting standards. So UK, the statement, that international, these include financial reporting standards and statement of standards, accounting practices, which outline the principles and procedures for financial reporting in the UK. So, international accounting standards, encompass international financial reporting standards. These standards issued by the International Accounting Standard Board, ISAB, provide a global framework for financial reporting, promoting consistency and comparability across international borders. So, in your assessment, you will be expected to prepare financial statement that comply with international financial reporting. So, in assessments, obviously, you are expected to prepare financial statement that comply with international financial reporting standards. Since January 2005, so EU quoted companies, including UK firms, have been required to use international financial reporting systems, ensuring consistency and comparability in financial reporting practices. So, understanding and applying these, standards in, accounting standard, these are essential for accountants and financial professionals to provide accurate, reliable, and transparent financial statements that meet the needs of stakeholders and regulatory bodies or regulatory requirement. So, international financial reporting standards. International, I just explained you that since 2005, since January 2005, so a global framework of international financial reporting standards represent a global framework for financial reporting adopted by EU, European quoted companies, included those even in the UK since January 2005. IFRS are standard issued by the International Accounting Standard Boards to provide a common language for financial reporting, facilitated consistency, comparability, and transparency in financial statements across international jurisdictions. So, a type of financial reporting system, the IFR IAS issued before. So IFRS, these standards have been issued by the IASB since 2001 and serve as the primary framework for financial reporting globally. Then International Accounting Standards, IAS, were issued before 2001 by the International Accounting Standard Board. The International Accounting Standards Committee, IASC, as you can see here, although some international accounting standards have been suspended by IFRS, they remain relevant to certain accounting treatment implementations requirement. European quoted companies, including those in the UK, are mandated to use IFR S for financial reporting purpose. Compliance with IFRS ensures consistency and comparability in financial reporting practices, enabling investors, analysts, and regulators to make informed decisions. Conceptual framework, IASB conceptual framework lays down the fundamental principles and concepts guiding the preparation and presentation of financial statements. It serves as a foundation of our accounting standard, but it is not an accounting standard itself. The objectives of financial statements, the primary objective of financial statement accounting to conceptual framework is to provide financial information about the reporting entity. The information should be useful to existing and potential investors, lenders, and other creditors is making decisions about providing resources to the entity. So understanding the objectives and users of financial statement along with the underlying assumptions of going concerns provide a framework for preparing financial information that is relevant, reliable, and conducive to inform decision making by stakeholders. Users of financial statements, general purpose financial reports. The primary users identify in the conceptual framework are investors, existing and potential, and lenders and other creditors. Financial statements are prepared to provide them with the information they need to make decisions about buying, selling, or holding equity and debt instrument, as well as uh, 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 yes. Yeah. So holding equity and debt instruments, as well as providing or setting loans and other forms of credits. So information needs of users required, the need information about entities. User requires information about the entity's economic resources, like assets and claims, liabilities, which collectively determine its financial positions. Additionally, they seek insight into changes in economic resources and claims financial performance and management efficiency and effectiveness. Underlying assumptions going concerns the conceptual framework, assumptions that financial statements are prepared under the presumptions that the entity will continue to operate for the foreseeable future. So these assumptions ensures the relevance and reliability of financial information presented in the statement. So understanding the need of users and the underlying assumptions of going concerns provide a context for the preparation and presentation of financial statement that meet the informational needs of stakeholders and contribute to informed decision making. Uh, any issues so far? Can you see my screen? Hear my voice?
No issue. Yes.
Okay.
Yes, everything's fine.
Welcome, Nizar.
Hi, thank you.
Okay. So then conceptual framework. Here, financial information make useful according to the IASB conceptual framework. So qualitative characteristics of useful financial information, qualitative characteristics, relevance information is relevant if it is capable of making a difference in decisions. This include the concept of materiality, where information is deemed significant enough to influence the decision of users. So further representations information faithfully represent what it purpose to represent when it is complete, natural and free from errors. So this ensures that financial information accurately uh, reflects the underlying economic reality of the entities. So enhancing qualitative characteristics, comparability, timelines, verifiability, and understandability. So comparability information is comparable when it allows user to identify similarities and differences between different entities or periods. Comparability enhance the usefulness of financial information by enabling users to make meaningful comparisons. Verifiability information can be uh, corroborated by independent observers, increasing in reliability and credibility. Then obviously timelines. Uh, Timely information is provided in a timely manners, allowing users to make decisions promptly based on current and relevant data. So understandability information is understandable when it is presented in a clear and concise manner, making it accessible to use with varying levels of financial knowledge. Materiality, IASB conceptual framework 3, fair presentations, true and fair view. So information is considered material if its omission or misstatement could influence the decisions that users make based on financial information about a specific reporting entity. In other words, materiality pertains to the significance of information in the context of the impact on user decisions. Fair presentations, true and fair view. The concept of fair presentation or true and fair view is required by the Companies Act, uh, yes, 2006. So, and international financial reporting standards. But neither IFRS nor the conceptual framework provide a specific definition of true and fair. So the concept is primarily a legal one, indicating that financial statements provide a true and fair view of the entity's financial position and performance. So conceptual framework is again continues. Continuing our exploration of the IASB conceptual framework, we will talk about elements of financial statements. So I hope all of you are familiar with these terms. Assets. Any comments on these terms? Anyone, Hinesh or everyone?
Yeah, the assets, very simply,
Yeah.
items or commodities that are owned physically or intangibly owned by the business and have value, both qualitative and quantitative financial value.
Yes. Correct. So asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow the entities. So basically, asset means everything. There are two type of assets also. That tangible and intangible assets. So then liabilities, equity, or owner's residential interest in the assets of the entity after reducing all its capital, also known as capital. So income, expenses, contributions, very common, all first five. So contribution from owners, contribution from owners reflect increases in equity, resulting from transfers from owners, while distributions to owners represent a decrease in equity resulting from transfer to owners. So both in their capacity as owners. So understanding these uh, all elements is essential for accurately preparing and presenting financial statements that provide a clear and comprehensive uh, view of the entity's financial position and performance. Intangible, as I said, there are two type of assets, intangible and tangible. So IAS 38, any definition by you guys, anyone can explain or comments intangible assets? Okay, so intangible assets is an identifiable non-monetary assets without physical substance, including brand names, technical knowledge, license, patents, trademark, goodwill, and development expenditures. So journal principles to be identifiable and intangible asset must either be separable from the rest of the business or arise from contractual or other legal rights. Intangible assets are recognized only when it is probable that future economics benefits will flow to the entities and the cost can be measures reliably. So upon initial recognition, intangible assets are measures at cost, which includes all directly attributable costs necessary to create or produce the assets to operate in the intended manner. So there are different kind of assets. Goodwill represent the difference between the cost of an required entities and the total fair values of its identifiable assets and liabilities. So internally, general goodwill, which arise over time through factors like reputation and technicals. Everybody knows that company's goodwill is so know-how is not recognized as an asset due to the inability to measure its reliability. So, however, purchased goodwill, which has a cost to the acquiring business and can be reliably measured at the time of the purchase transaction, is recognized as an asset, the statement of financial position. So other internally journal intangible assets. Uh, so IS 38 prohibits the recognition of other internally journal generated intangible assets such as brands, must publishing titles and consumer lists. So this is because their value cannot be measured reliably. So understanding the distinction between internally and externally journal intangible assets as well as the accounting treatment of goodwill is essential for accurately reflecting an entity's financial positions and performance in its financial statement. So research and development expenditures, research and research expenditure is recognized as an expense in the profit or loss statement when incurred. So this is because research activities are typically exploratory in nature and do not result in the certain identifiable assets with future economics benefits. Amortization and impairment. Amortization, the useful life of an intangible assets can be, finite or indefinite or finite. So if the asset's useful life is finite, it is amortized over the useful life, following this, same principle as depreciation for tangible assets. So uh, if the asset's useful life is indefinite, it is not amortized. So impairment for intangible assets with useful lives, as an impairment review is conducted when there are indications of impairment. So this could include factors such as significant declines in market value, adverse changes in businesses or market conditions, or operating losses related to the assets. So for intangible assets with the indefinite useful lives, annual impairment reviews are required. This includes goodwill acquired in a business combinations. So impairment of assets, impairment refers to reductions in the recoverable amount of assets below its carrying amounts. Impairment loss occurs when the carrying amount of an asset exceeds its recoverable amount. Impairable review. Impairment review is carried out when there are indications that impairment may have occurred. So this could include significant declines in the asset market value, uh, intangible asset with the indefinite useful lives and goodwill required in a business combinations requires annual impairment reviews regardless of whether there are indications of impairment. So measuring impairment as an asset is measured at the lower of its carrying amount and its recoverable amounts. So the recoverable amount is the higher of its fair value, less cost of disposal, and its value in use. Determining impairment. So determining impairment, it is carrying amount of an assets exceeds its recoverable amount, the asset is impaired. So the impairment loss is calculated as the difference between the carrying amount and the recoverable amount. So then value in use. So value in use, value in use refers to the present value of future cash flows expected to be obtained from the asset. So it represents the economic benefits that the asset is expected to generate over its useful life. Treatment of impairment losses. So accounting for impairment losses. Original cost, if the asset is carried as its original cost, any impairment loss is recognized immediately in the profit or loss statement. So this means that the loss is directly deducted from the entity's income for the reporting periods. Revalued assets, if the assets has been revalued above the original cost, any impairment loss is treated as a downward revaluation. So this impairment loss is recognized in other comprehensive income, effectively offsetting any previously recognized revaluation surplus. So comparison with depreciated historic cost, if the recoverable amount of the asset is less than its depreciated historic cost. So the difference is recognized as an impairment cost in the profit or loss statement. Inventories or assets held for sale in the ordinary course of business in the process of production for such sale or in the form of materials or supplies to be consumed in the production process or in the rendering of services. So course of business in the process of production for such as sale or the form of material supplies to be consumed in the productions process or in the rendering of services. Measurable basis inventories should be measured at the lower of cost and net realizable value. So this means that inventories are valued at the cost of acquisition or production or their current market value, whichever is lower. A cost conclusion, the cost of inventories includes all cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and conditions. So abnormal production costs, administrative overheads, and selling costs are not included in the cost of inventories. Net realizable values is the estimated selling price is in the ordinary course of business less the estimated costs of completion and the estimated cost necessary to make the sale. Methods of arriving at purchase cost. So annual cost used when times are not ordinary interchangeable, first in FIFO method, first in, first out, last in, first out, not allowed, weighted average cost, use some methods for all inventories having a similar nature of use. Basically, actual cost, the method is used when terms are not ordinary interchangeable. It involves recognizing the actual cost incurred for each specific inventory item. First in, first out, or FIFO method assumes that first time purchased or produced are the first ones to be used or sold. So it matches the cost of the earliest inventory items with current revenue. Then a weighted average cost, or AVCO, calculates the average cost of all units available for sale during the accounting period and assigns this average cost to units sold or transferred out of inventory.
Sorry, Asir, could you explain again, just repeat again the first in, first out, or the last in, first out definition, or like
Yeah,
just explanation?
there is no last in, first out. We are not discussing here last in, first out.
Okay.
Okay. The first in, we are just talking about first in, first out, assumes that the first time purchased or produced are the first ones, okay, to be used or sold. It matches the cost of the earliest inventory items with, current revenues. So whatever we'll purchase first, that will go out, first.
Okay. Okay.
Okay. It's a famous accounting method, LIFO and FIFO.
Okay, thanks.
So provision, can you guys see my screen now? No issues?
Yeah, I can see.
Yeah, provision, contingent liabilities, and assets. So definitions of provision. Provision is a liability of uncertain timing or amount arising from past events for which the settlement will likely requires an outflow of resources, embodying economic benefits. Recognition criteria. Provisions are recognized when three conditions are met. You know that Matt, Matt,
Yep.
did you ask about a question first in, first out?
No, I think that was Nizar.
No, it's
yeah.
me.
Yeah, Nizam, if you go to the stores, have you seen that, let's say, you're based in UK, aren't you?
Yeah.
Yeah, let's say if you go to Tesco, you always see, that expiry dates, which are, let's say, today's date or tomorrow dates. Let's say you
Mhm.
buy a mail, so dates of, closer to expire, you will see in front, So
Yeah.
that's, they buy first and they should go out first in, first out. You understand?
Okay.
So if you
Okay.
pick bottle from back, from back side, you will see that might be expire date will be 1st of June,
Okay.
So they always, it's a simple example. They always, whatever comes first into the, stores or for production or wherever, it go out first as well. First in, first out. Okay.
I see. Okay. Okay, perfect. Thank you.
You understand now?
Yeah, I do. Yeah.
Okay. So
Thanks.
provisions is a possible obligations arising from past events. So the sorry. Yes, so provision is a liability of uncertain timing or amount arising from past events for which the settlement will likely requires an outflow of resources embodying economic benefits. So recognition criteria and measurements provisions are recognized when three conditions. The entity has a present obligation due to past events. It is probable that an outflow of resources will be required to settle the obligations. A reliable estimate can be made of the amount of the obligations. Measurements provisions are measured at the best estimate of the expenditures required to settle the obligation at the reporting date. So basically, understanding the recognition and measurements criteria for a provision is important for accurately and reflecting the entity's financial position and performance in its financial statement. All good? Any issues? You okay, Hinesh?
Yes, okay.
Okay, so standard accounting standard 37 provisions, contingent liabilities and assets will continue. So definitions, liabilities and assets, possible obligations that assets from past events and whose existence will be confirmed only by the occurrence of one or more uncertain future events, or present obligation that is not recognized. So basically, contingent liability is a possible obligations arising from past events, the confirmation of which depends on uncertain future events. If the possibility of transfer of economic benefits to settle the obligation is not remote. So it is disclosed in the financial statement, but it is not recognized as liability until the occurrence of the uncertain future event comes its existence. Contingent assets is possible assets arising from past events, the confirmation of which depends on uncertain future events. These assets are not recognized in the financial statement, but if it is probable that an inflow of economic benefits will occur, it is disclosed in the financial statements. So understanding the distinction between provisions, contingent liabilities and assets is important for, again, accurately reflecting an entity's financial position and potential future obligations benefit. Provisions, contingent liabilities and assets, 37 continues. So part 2. So here we are continue our discussion on international accounting standards. So regarding provision, contingent liabilities and assets. So focus on the decision-making process, uh, uh, decisions tree of recognition, present obligations. Does the, does the entity have a present obligation resulting from a past event? If yes, proceed to the next step of if no provision is recognized, okay, not possible or recognized. Reliable measurements, can the outflow the measured reliability? If yes, recognized is recognize a provision, no provision is no provision is not recognized. Contingent liability, if there is a possible obligation with the likelihood that is not remote, decision is a contingent liability. If the likelihood is remote, no action is taken. So basically, understanding the decision-making process outlined by International Standard 37 is essential for accurately recognizing provisions and disclosing contingent liabilities in the financial statement. Even after the reporting periods, standard 10. So definition of event after reporting period, as you can see here, the events after the reporting period are those events, both favorable and unfavorable, that occur between the end of the reporting period and the date on which the financial statements are authorized for issues. So adjusting events and non-adjusting events. Adjusting events provide evidence of conditions that existed at the end of the reporting period and required adjustment to the financial statement. Non-adjusting events are indicative or conditions that arose after the reporting periods and do not require uh, adjustment, but may necessary disclosure. Example of adjusting events include evidence of impairment of assets, while example of non-adjusting events include the purchase of sale of assets. Next is 18, section 18 or IAS 18 revenue. So revenue is the gross inflow of economic benefits arising in the course of the ordinary activities of the entities. Revenue is measured at the fair value of the consideration received or receivable. So revenue recognition criteria, for revenue from the sale of good, revenue is recognized when significant risks and rewards of ownership are transferred. The amount of revenue can be reliably measured, and it is probable that economic benefits will flow to the entities. For revenue from rendering services recognized based on the stage of completion of the transactions at the end year, if the outcome can be estimated reliably. Dividend income is recognized when the normal criteria of revenue recognition are met and the shareholders' right to receive payment is established. So understanding the criteria of revenue recognition outlined by International Standard 18 is essential for accurately reporting revenue in the financial statement and ensuring compliance with international accounting standard. Recognition property of recognition of should be here, but this is basically recognition of plant, property and equipment. So property, plant and equipment are, as you know, tangible assets used for various purposes such as production, supply of goods, services, rental or administrative tasks. Examples include land, building, machinery, computers, vehicles, and other office furniture. Subsequent expenditures is only added to the cost of and time if it is likely to result in a future economic benefits, excluding servicing cost like repair and maintenance. Recognition of these assets occurs when it is probable that future economic benefits will be received and the cost can be reliability measures. Initial measurement is done at cost, which includes the purchase price and direct cost to bring the item to its intended use, like delivery and assembly cost, excluding administrative expenses or staff training. Measurements after recognition, property, plant, and equipment can be measured using either the cost model or revaluation model. Under the cost model, assets are recorded at historical cost, less accumulated depreciation, while under the revaluation model, assets are periodically evaluated to fair value. Revaluation gains are recognized in other comprehensive income, while revaluation losses are recognized immediately in profit or loss. Fair value represent the price that would be received, sell an asset in an ordinary transactions, usually considered as market value. Revaluations should be done regularly to ensure the carrying amount is close to fair value. Depreciation and disposal. So, any comments about the depreciations? Anyone? Hanesh? Okay, so depreciation and disposal. Depreciation is the systematic allocation of an asset's depreciations amount over its useful life. Uh, this excludes land which typically has an indefinite life. Depreciable amount is the cost of revalued amount minus the residential value. Depreciation methods should reflect the pattern of assets consumptions. Periodic reviews should be conducted to assess the depreciations method, residual value, and useful life. Any changes are treated as changes in accounting estimates. Disposal occurs when an asset is sold or no longer provides economic benefits. The gain or loss on disposal is calculated as the net sale proceeds minus the carrying amount and is recognized in profit or loss. Review of depreciation, change, disposal, and de-recognition. So, change charges annually, adjusting methods, residual values, or useful lives as needed. Changes in estimates are treated accordingly. A de-recognition of an assets happen when disposal or when no future economic benefits are expected. Any gain or loss from disposal is recognized in profit or loss for the period, calculated as the difference between net sale proceeds and the carrying amount of the assets. So these processes ensures accurate reporting of property, plant, and equipment in financial statement. Disclosure in financial statement. Disclosure is important for obviously transparency and understanding of an entity's financial positions. So land and building, plant and machinery, motor vehicle. So for land and buildings, disclosure typically include the cost or evaluation at the beginning and end of the years, along with any additions, revaluations, disposals, and depreciations. So similar information is provided for plant and machinery, motor vehicle, and other assets. So this pro forma note, as required by International Accounting Standard section 16, or summarize key details like measurements basis, cost, or fair value. So depreciation methods and useful life, such disclosure offer stakeholder insight into the value, utilizations, and management of tangible assets within the organization. Requirements of International Accounting Standard 7. The statement of cash flows presents a summary of all cash movements in and out of business during a specific period adding users in assessing the entities, cash generation capabilities. Cash includes funds on hand and demand deposits, encompassing items like current accounts, petty cash, and bank overdrafts. Cash equivalents, on the other hand, are short terms, highly liquid investment, readily convertible into cash with minimal risk of value changes, such as deposit accounts or investment maturing within 3 months. Cash flows represent the inflows and outflows of cash and cash equivalents, offering a valuable insight into entities' liquidity and financial health. Uh, Operating activities, these encompass the primary revenue generating activities of the entity, and other non-investing or financing activities. IAS 7 permits two methods for representing cash flow from operating activities: indirect methods and direct methods. So indirect methods reconciles profit before tax to net cash from operating activities with adjustments made for items such as finance costs, depreciations, dividends received, and changes in inventories and receivables. Direct methods list and total actual cash flows. uh, this approach directly lists and totals actual cash flows from customers, suppliers, and employees. Then investing activities and financing activities. Activities involves the acquisitions and disposal of long-term assets, and other investment are not classified as cash equivalents. Financing activities, these activities resulting in changes in the size and composition of uh, contributing equity, share capital, and borrowing of the entity. Requirement of IAS 7 in the statement of cash flows using the indirect methods. The formal typically includes a recognition of profit from operations to net cash from operating activities for the year ended. This reconciliation involves adjusting profit before tax for various items like finance cost, depreciation, dividend received, gains, losses on disposal of assets, and changes in inventories and receivables. Then requirements of 7 continue. Yeah, here the statement of cash flow for the year ended, delineates the net cash from operating activities, investing activities, and financing activities. Separately under cash heading, uh, specific cash flows are listed, such as the purchases and disposal of property, plant, and equipment processed from share capital, insurance, bank loans, dividend paid, and interest received or paid. So finally, the net increase in cash and cash equivalents in calculated along with the closing balance of cash and cash equivalents at the end of the reporting period. Preparing the statement of cash flows, start with the profit before tax and then adjust in accordingly. Cash generated from operations begin with the profit before tax and back finance cost with typically align with the interest paid, then add back depreciation, deduct any dividend received as they should be included in investing activities, adjust for gain or losses on assets disposal, add back losses, deducting gain, deduct any increase in inventories or trade receivable as these represents a decrease in cash. So finally, add back any increase in payable as this indicates an increase in cash. Indirect, yes, interest and taxes. So if there are no accruals, treat the interest charge as a cash outflow for tax. If the expenses equals the closing payable, the cash outflow equals the opening payable. Otherwise, calculate the cash flow as the opening balance plus the change for the year minus the closing balance. Investing activities, calculate the purchase of property, plant and equipment by considering the opening balance, disposal, depreciation and closing balance. Determine proceeds or disposal from the carrying amount, and profit or loss on disposal include dividends received if any. Then financial activities, the cash flows for financing activities is typically the difference between opening and closing figures in the statement of financial position for items such as share capital, share premium, and loans. If dividends are not provided, so cash and cash equivalent, uh, the net increases or decreases should equal the difference between the closing and opening figures in the statement of financial positions. Analyze ethical requirement of corporate reporting. Accounting must behave ethically, and several reasons we discussed previously as well in our one of our accounting lectures. Laws and regulations, accountants must adhere to legal requirements and regulations governing financial reporting, professional standard and qualities, upholding professionalism standards and qualities, both personally and professionally, is essential for maintaining integrity and trust. Protection of the public interest, ethical behavior ensures that financial information is accurate, reliable, and serve the public interest. Then IFAC Code of Ethics, the International Federation of Accounting has its own code of ethics emphasizing integrity, objectivity, professional competence, and due care. So confidentiality and professional behavior. Then ethical principles, threats to independence. These include self-interest, self-revenue, advocacy, familiarity, and intimidation. Independence is important for ensuring the reliability and credibility of financial information. Importance of independence. Independence promote the reliability and credibility of financial information, the value of audits, the credibility of the profession, and public trust. Professional safeguards in professional safeguards, uh, entry requirements, training, CPDs, professional standards, monitoring, disciplinary procedure, and external review are safeguards that help maintain ethical behavior in practice. So these includes peer review, independent consultation, partner staff rotation, discussion, disclosure to audit committee, and performance by another firm. Close business relationship. These involve situation like employment with the client, having a financial interest in the client, recent services with the client, or providing other general services. Such relationship can create a self-interest threat. Family and personal relationship. Ethical concerns arise when there are close family or personal relationships with client. Additionally, gifts and hospitality from clients can pose a threat to independence. For example, if an auditor is involved in preparing client accounting record and financial statement, there may be a self-review threat. Advocacy, conflict of interest. Advocacy threat, this occurs when accountants act as advocates from their clients or only earns fee if a successful outcome is achieved. Contingent fees, examples including providing legal services and corporate financial services. Then conflict of interest. Conflicts may be arise when accountants represent clients who are in dispute, or when there are disputes between client family relationships, between the client and the firm. So personal relationships, long association with clients, recent services provide to client, and potential future employment with clients can all create threats to independence. Intimidation threat. Intimidation threats can arise from close business relationships, family relationships, personal relationships, staff employed by the client, or litigation situations. So these threats may compromise the auditor's ability to act independently and objectively. Yeah, that's it for today. Here are some references, and for further reading, you have some books or material available on your learning management systems. So if you have any any questions, issues, and concerns, you can drop me an email at yasir@ukversity.co.uk. Thank you very much, everyone. So any questions, concerns, or issues? Anyone there?
No.
Okay, all good, Hinesh?
Yeah. Thank you.
Anyone has a lecture today? I have a lecture 2 o'clock coming, law of accounting. Anyone is studying law of accounting?
No.
Okay. So I'll see you tomorrow at 10 o'clock again. By then, thank you very much, and bye for now, and have a good weekend ahead. Okay.
Thank you. Thank you very much.
Thank you very much.
Thank you.
Everyone. Thank you.
Bye-bye.
Thanks. Have a good day.
Thanks very much. Bye. Bye.
Thanks. Bye.
Aftab.